You are now good to go.
Right.
Victor's trying to come in. Alan Badanes, me too. Link says host has another meeting. I'm not sure why that is.
Maybe they're
Okay.
coming off that town council.
Yeah,
Yes.
but I'm just gonna send the code here. I don't know why they're having trouble.
I'm in. Sorry.
Oh,
Jen.
you're in, Maria?
No, Jen Zonas.
Oh, yeah, no, Maria Weingarten is having trouble
Oh,
getting in.
sorry.
2397. And passcode is 6. All right, let me try that with a few folks. I don't see anybody in the wait room. I've got Alan and Maria and Victor. So I just sent them the code. Let's see if they come in.
Let's give them a couple minutes to log in.
Yep.
You completely dug out, Chris?
Am I?
Yeah,
Yes, finally.
good. I think I was dug out by this morning, but
Yeah, that's when our guy came this morning. They had
no. I have the unfortunate
Here we go.
circumstance of owning my own snowblower. So I don't call the guy because there's an economic recovery that is underway. Well, we bought it many years ago, so it actually doesn't owe me anything because I think it's about 10 years old, but it's it did a great job. So
Such is in.
Steve, you do your whole driveway with a snowblower?
yeah,
Boy. How many inches? 24?
it is a compact Ariens 24-inch. Yes.
Yeah, I think I need a 30 or something. I can't picture going up and down the driveway with a 24. That might kill me.
You know, I'm not going to lie. I have to admit it's a lot, but
Hey, Tucker's, are we, see Alan's in.
Yes,
Is
I just
Maria-
told
is Maria in?
she's trying. I just gave it to her and Victor 2397. This code. I think you could get started and just maybe hold off. We know they're coming. It's just Maria and Victor.
Well, we do have to call the rolls, seat alternates.
Yeah, they're going to be on though. I've just given them the code. I don't know why they're Alan, that code I gave you obviously worked. I see you're in. Okay.
yes.
Okay. Uh, I've been on Zoom meetings all day here.
Sounds like a lot of fun.
Right?
Definitely
Living the dream.
definitely haven't missed it.
COVID brought us this technology, right?
Who's that, Jen?
I said COVID brought us this technology.
All right, Tucker, we okay?
It's
Yeah,
one of the
Maria
benefits.
said to
Yeah.
get going. She's having some Zoom update issues. So she
All
said to
right.
keep just to get going.
All right, it's 7:08 p.m. This is the Board of Finance regular meeting on on Tuesday, February 24th. And I will call the roll. Victor Alvarez, Alan Badanes,
Here.
Michael Chen,
Here.
Steve Doka,
Here.
Bob Hamill,
Here.
Todd Lavieri,
Absent.
Chris DeBreeze is here, Nick Matrakis,
Here.
Jan Schaefer,
Here.
Maria Weingarten, James Yao,
Here.
and Deanna Carlson.
She is in flight, hopefully.
Okay, so we need to seat somebody for Todd and Victor. So that would be
I'm one of the alternates, Chris.
yeah. So Steve and
Alan, I think, right?
Yep, Steve and Alan, we could do.
Steve and Alan. Jan, you were recently on.
Yeah, she's,
Yeah.
Okay. All right. So may I have a motion to seat Steve and Alan for Victor and Todd?
I'll move.
James Yao, second. Nick Matrakis, all in favor?
Aye.
hi.
All right.
Any opposed? Okay, they're seated. Todd has asked me to chair the meeting, but I think we need to have a vote to make me chairman pro tempore of the meeting. So I have a motion to that effect.
Motion.
I will, second.
Bob,
Steve.
Michael. Okay, all in favor?
Aye,
Aye.
aye.
Okay, passed. All right. So our agenda tonight is pretty straightforward. We have our friends from the Board of Education here to talk to us about healthcare and insurance costs. So, Brian, I'm going to let you run the show from here. I suggest that if you're while we're listening to the presentation, we all mute our machines, and then let's let them have their say, and then we can ask questions at some point. There'll be a break, and then we can open for questions. Brian, you're on.
Thank you, Chris. And thank you for everyone juggling their schedule. I know that this meeting was sort of on again, off again, and it's great to be with you. And thanks for making it happen virtually, because I don't think we could have done it otherwise. Tonight, we've got a couple of things that we'd like to share with you, to touch base about. We've got Joe Spurgeon here, who's been with the Board of Ed a little over 10 years now. And Joe has worked as our insurance expert, consultant, advisor, both with our annual process of building our projections and understanding sort of what we're looking like for our anticipated claims as we build our budgets. He also provides us with monthly updates on how our plan is performing. And Joe is also an advisor that helps us out anytime we go into negotiations with our groups, because as you can imagine, the structure of the plan is something that's always being refined as we are in negotiations and working with each of our groups. And it's done in partnership. We've been very fortunate through the years to have great partnership with our teachers unions, our other unions, where we understand that this is a benefit for our folks and it's something that we invest in together, right? So that partnership has helped us to, I think, continue to refine our plan and to put some good options into place and some cost-saving measures that if we get there, we can share and exhibit with you if that comes up. But Joe is here with us tonight again, so thank you for rearranging your schedules and being here. And I'm going to turn it over to him in a moment. And so after Joe is able to go through a bit of plan performance and the projection and answer any questions and talk a little bit about insurance, then we'll shift over to, and Sean's going to talk a bit about our internal services fund, where, of course, we hear from Joe and learn from him about our plan and his performance and the projections, et cetera. Then it's the matter of building the budget into the internal services fund of what we'll need in order to pay for the fund, the claims, and to continue the plan running the way that it is. And understanding that our internal services fund is anticipated claims, other fees, net of our employee contributions and their deductible costs, and excuse me, also has the reserve. So Sean will be able to talk about all of that as we go into it. But thought it would make sense for us to start with Joe, since that's the basis of the budget for the ISF. So Joe, if you want to take it from there, it's all yours.
Okay, so what we'll do is when Joe's finished, we'll open up for questions before Sean comes on.
Perfect.
All right, good.
Great. Hello, everybody. Good to see you. I think about once a year I see you all, usually in person. So happy to be here. I personally like in person better because I can see your faces better and know if you're following me or not. But anyway, so I think my goal tonight is to kind of walk through, and I think most of this group has probably seen my presentation before, So I'll walk through running claims to date and then go through the projection as well. And then anything else that I can help address, I'm happy to do that. So I'm going to share my screen. And I believe or hope everybody has a copy of this. I know I might have come over a little late, but
Yeah,
First one
I just want to jump in there. Board of Finance, I just
Yeah.
sent you something a short while ago that you should have, and I put some other documents that Brian had sent on to the tablets.
And I'm going to blame the snow for the tardiness of some of those documents. So
Is this,
Thank you.
is the one you just sent, is that different from the one you sent earlier in the day?
Is this
Tuck-
one, Brian, the one that I just got at 5 o'clock tonight that we're looking at now?
Yeah, there's one
Yep.
change. It's the fiscal year to date average and the pink box, the bottom number changed.
All right,
Yeah.
very good. Thank you.
I'll
But you
address
should,
that.
you
for
should have this. This is the one I think that you maybe received yesterday. But I'll make sure that Tucker, you know what I'll do after the meeting? I'll put everything together in one package, send it
Thank
to
you.
you, and then you can send it out. We'll just make sure everybody has a hard copy of each of the exhibits.
Thank you.
And just, yep, thank you.
Yeah, and to Maria's point, what I'm going to show you on my screen is slightly different because we identified an error in the averages earlier on the earlier call I had with the Town Council Board of Finance Board of Ed Committee. Do I have that right? So I did correct that for this. I found the error. Maria, I'll explain it when I get to that. So first we look at, so just, I guess, quick refresher for everybody on the call. New Canaan is a self-funded group. What that means is that you are liable for all claims that are incurred against the plan. Cigna serves as our carrier or our third-party administrator. It doesn't have to be Cigna; it could be anybody. But what Cigna does for us is they provide our provider network. They adjudicate the plan design that we negotiate with the unions. So is something covered? What's the deductible? What's the copay? If there's a copay, right? They do all of that work. They provide us with the provider network discount at the providers, and they handle customer service calls. So if somebody calls, they're not calling Brian to find out if something's covered, right? They're going to call Cigna and say, "Hey, is this procedure covered?" And then lastly, they facilitate the actual payment for our services. When I say they facilitate our payment, what I mean by that is they literally will say, okay, Joe went to the doctor. It was $150. That's the negotiated price. We're going to pay Dr. Jones $150. They pay that $150 by withdrawing that from the Board of Education's self-insurance account. So we are physically paying all claims that get incurred. Cigna is just processing those payments for us, but via our own checking account. We do also have stop loss insurance, so we are only liable for claims up to $300,000. Our stop loss vendor is not Cigna, so we have to pay all claims that are incurred against the plan, and then for anything that's over $300,000, we get reimbursed by the stop loss vendor for that. And I'll kind of talk a little bit more about stop loss later. So on this first page that we're looking at, this is our claim tracking sheet, and we're tracking claims by month. On this report, I'm tracking net paid claims. So I'm tracking those claims up to the 300,000. If something's over the 300,000, I'm not tracking it on this report. On the next page, I do show gross claims, which includes those claims over 300,000. But here I'm just tracking net. And then also just earlier we discussed with the earlier group, I'm only tracking claims here, not fees. The idea is, the vast majority of the costs are associated with claim costs. That's what's driving our budget projections, is what's happening with claims. And so from these reports, we're really just tracking the claim cost on a monthly basis. I do report on page 2 what the stop loss premiums are, really more illustratively. But this is really looking at what's happening with claim activity.
Joe?
And so, yes.
Joe, this is Michael Chen. Just want to confirm the $300,000 cap is per client, per person or whatever, per family, over the annual period, correct?
Correct. So it's thank you. Good question. So it's per person, so per member. So if I'm a family of four and my son has a large claim, it's 300,000 for all of us, right? So it's per person, and it's per year. And just to note, it's per plan year, which runs September to August. It's not a fiscal year plan. It's a school year plan. So really, it's a union contract year plan. Is what we've kind of tied it to.
Right. So if a family of four capped at 300,000 and a family one is capped at 300,000 for the
A
family.
family of, so it's per person. So if in a case of a family of four, each person would have 300,000.
Okay.
But we don't, it's not aggregated at all. It's just per person 300. There's no aggregate. Like a family's not maxed out at any certain level.
Okay.
It's 300,000 per person, and we call that a member. So it's a per member cap.
Great. Thank you.
That we talk about. So what we do is we run this report, and because I just said we run on the school year, right, September to August instead of the fiscal year. What we learned a few years ago is I was reporting out to you guys and to the Board of Ed and saying, hey, here's your annual claims, and it wasn't tying back to anything because I was tracking plan year and you all look at fiscal year. So we kind of came with this color coding to try to help that a little bit. And so it's probably easiest to look at if you look at this blue column with two rows of data in the brown boxes, and then the brown column with 2 months at orange. So what this is doing I'll use 21-22 for 21-22, this 13,769,000 is tracking the full plan year, September through August. But then to help you guys tie back to fiscal year stuff, what I did is say, okay, well, let's also track the fiscal year. And so the fiscal year is going to just track the brown box, right? So it's going to get my July and August from the prior column all the way through June of the current column. That will give me my fiscal year to date and then the average. So when you're looking at that, just know that there's two sets, right? You can see your fiscal year average and your plan year average. I'll jump ahead. Maria's group was kind enough to point out that on your sheets, this is going to be a $1.8 million number in this pink box, which was the average fiscal year to date. It should be 1.257. It was only divided by the 4 months of the plan year, not the 6 months of the fiscal year. So it's corrected now. Brian, I think I sent that over to you. So maybe when you resend everything, you can include the corrected version in it.
Yep, I have it, Joe.
Okay.
Thanks.
Oh, great. So where I think this is most helpful, especially during budget time, is when we're looking at, obviously you can quickly compare year to year. But for budget purposes, and we'll talk about this more when we get into the projection, for budget purposes, I'm always using the most recent 12 months of claims experience. So when we do projections, and again, I'll talk about this more, we're looking at your actual claims for whatever the most recent 12-month period is, and I'm going to project that forward into the next plan year. And so every time I add a month, and you guys have seen this before, right? We start in New Caney, we start the budget process fairly early. We're doing projections almost monthly. Maybe we miss a month here or there, but typically monthly. We're doing projections from late in the calendar year till right up to your budget time. And every time we have a new month of claims, I do a new projection with a new 12 months of claims. So why this exhibit is somewhat helpful is when you're looking at claim activity, you can get a general sense on how are we running and is an update going to help us? And so, for example, my initial projection with Brian and Sean was through November. And we then updated, you'll see it in a second, we updated through December. And what you can see here is that December of 2024 was nearly $1.6 million, while December of 2025 was $1.3 million. What's going to happen when I update my running 12, I'm going to drop the 1.6 and replace that with a lower number, the 1.3. So while it doesn't always work out this way, typically in these scenarios, you would expect that the claim projection would improve, right? Because I'm dropping a higher month and replacing it with a lower month. On top of that, I'm also using less trend, which will make more sense in a little bit. So that's where I think this sheet is helpful. Like you could even see, January was not a super high month, but it was a higher month, higher than our running average is. So when we get January claims, we might see some further improvement if it's lower than $1.4 million. Okay. Down below here, we bring in our average contracts and our average members. So Michael, I'll get to kind of your earlier question. So a contract is the employee or the retiree that you're obligated to provide coverage to, and is actually enrolled in your plan, right? So 626 people are currently enrolled in the plan on average for this current plan year. Members count those employees or retirees and their dependents. So my example, I'm a one contract, but I'm a family of 4, so I'd represent 4 members. So that's representing contracts and members. Down below here, this yellow box, I wouldn't take a lot of credit to it right now. It's, we're not even in a full year, we're not even half year in for the plan year. There's a lot of variability in claims. We typically expect the first part of the year is going to be lower for claims. The second part of the year, claims increase. That's a function of people hitting their deductibles later in the year. It's a function of people who are going to hit stop loss, might take them a while to get there. So really this yellow box is going to be updated. I wouldn't take I wouldn't take that number too seriously at this point. You'll see on the next page though, we are running well this year. So we'll get to that as well. But we do break out a per contract cost. And again, this is just claims as well as a per member cost. And then we give you a percent change at the bottom. So for these, full completed fiscal years or plan years, you can see the percent change year to year and the per capita costs. On page 2, I think for like these types of meetings, this report is probably more helpful, because what we're looking at on page 2 is a couple of really important things. How are we running versus expected claims, and what's going on with our catastrophic claims. So for catastrophic claims or high dollar claims, so you'll see catastrophic and you'll also see HDC, high dollar claimant. We're defining a high dollar claimant or a catastrophic claimant as anyone with claims over 50,000 for medical and drug. We don't count dental into that number. And in section 2, I'm only tracking your liability. So it's tracking between the 50 and the 300, right? So what was your liability for claimants over 50,000? And we'll walk through that. It's an important kind of component of our overall cost. So, but look at section 1 first. We bring in our expected claims for each year. For this current last column, which is the current year to date, we're going to bring in the expected claims. And then also we do kind of a straight annualization of that or de-annualization of that number. So we take the 18.1 divided by 12 multiplied by the current months to say where would we be kind of year to date as we're 4 months through so far. Let's look at last year, and then we can look at this year. The next page actually down is a little bit more helpful for the current year. So for last year, we expected claims to be about 17.3 million. Gross claims came in at 18.5 million. We had $818,000 over the 300, so over the stop loss. So our net claims was 17,654,000. That means we ran $357,000, almost $358,000 over the expected number, or about 2% over. I do report stop loss here. Our stop loss premiums were nearly $1.5 million. Let's take a little time and look at that. So we paid $1.5 million for stop loss. We only had $818,000 in excess. So Sun Life did pretty good on that last year. Important note here, as I think all of you know, we are pooled with the town for stop loss. I'm not privy to what the town's performance has been historically. So it could be that our premiums are slightly high the last maybe couple of years. Perhaps the town is doing a little bit worse. So because we're pooled together, our premiums are higher. If we were standing on our own, what I would say is that we'd be in a pretty good position to have a very, very favorable stop loss year, given the last 2 years of losses have been much less than what the premium exposure has been. But now saying that, if you look at the first 2 years, in 2020 through 2021, Voya paid out $1.6 million. Our premiums were less than $800,000. In 21-22, they paid out 2.6 million, and our premium was just over $1 million. 22-23, we kind of started getting to maybe targeted level. I would still say in this scenario, Voya did a little better than what our kind of target would be. I typically would target about an 85% loss ratio. And what I mean by that is if you take your losses, so the 1.2 divided by the total premium, the 1.65, a targeted ratio would be about 85%. And they did better than that, right? They did about 70%. So they did okay that year. You might say, well, they're trying to make up for those past years, which is likely what we're trying to do there, what they're trying to do there. One of the nice things about stop loss, though, and you can see we moved, right? Went from Voya to Sun Life. And actually, I think it was just the year prior we were a Sun Life before. So we went Sun Life, Voya, Sun Life, Sun Life. Stop loss is an easy product to move, right? There's no member disruption if we move stop loss carriers. It doesn't impact the employees at all. And so unfortunately for the stop loss vendors, what tends to happen is when you have a couple of bad years in a row, and then you get a couple of good years in a row, that current carrier is looking to make up some losses. You just take it out to bid, and you can usually find a new carrier is going to rate you closer to your current level and likely move. And that tends to be what happens in the stop loss market. I'll pause there just because that section 2 is a little bit different. So if there's any questions, I'll pause here for a second.
No, it's Alan Padane's.
Yes.
Quick question. When you shopped it and went from Voya to Sun Life, does Sun Life have the benefit of seeing our past performance?
Yes. Yep. So they get claims experience. They have the ability to ask some questions on like prognosis, financial prognosis of a claimant, and all that's provided during the RFP process.
And then maybe this is a later question when Sean talks, but you mentioned that it's not, you have no visibility of the town, but I guess you don't have to answer it, and maybe we can do it later, but do Ann and Sean compare notes to see if it's optimal to continue to pool? The stop loss.
Yeah. I know. So Larry Kirshner from Epic, who's a Towns consultant, he took on the stop loss piece, and I'm sure he's managing it well. I would expect that generally the pooling has been helpful. Otherwise, we likely would have visited kind of getting separate quotes.
Okay.
If it wasn't. But it may be a good question for Larry or for the town to follow up with Larry just to kind of see. But I would expect. I mean, Larry knows how to do the numbers, right? So I'm sure it's beneficial.
Okay, thanks.
So Joe, this is Chris. Yeah. So over the 4 years that Voya was the stop loss carrier, they lost $700,000 on us, $800,000, right?
Yeah, more, right? They lost over 800,000 in just 2021, right? 20 to 21, and then they lost $1.6 million.
Yeah, I think they're down about $760,000 in those.
Yeah, 762 is
that. They're giving them credit for the
yeah, because then they get a little bit back. But yeah. Still we came out ahead for sure.
Is this pattern always true? I mean, if it is, then why would anybody do this business?
Well,
what's the insurance companies are not in the business of losing money.
Yeah. The biggest issue right now. So the biggest factor of your costs right now is the cost of large claimants. What I mean by that, like the biggest variable, the biggest unknown is the cost of large claimants. And when I say cost of large claimants, that covers two things, right? It's our actual claim liability. So how many more large claimants are we going to have, or how large are those large claimants going to become? And then what we're paying in stop loss. And so what we're seeing in the market is the stop loss market is pretty tight right now. And if I can jump ahead a little bit to the bottom of page 2 here, I mean, what you can see is over the first 3 years on this report, we had a claimant, right? This is our largest claimant right here. Each of those years, we had somebody over $1 million. So, let's say our 24, our last plan year, right? Our largest claimant was 781, which is still a very large claimant. Don't get me wrong, right? But, we could be sitting there with this scenario, we're paying 1.5 million and they only paid out 817, but they're $1 million claimant away, right, from absorbing all of that. So the market is pretty tight right now. It requires a lot of conversations back and forth with the vendor about what we think's happening, what they think is happening. In this case, kind of bringing in Cigna to provide some insight. But it is a somewhat sketchy market at this point.
No, but I don't see how they figure out what the risk is because it's so random, right? People get sick at random times. Various treatments, therapies cost more or less depending on what these people have. You just never know. So how efficient is this?
Couple factors, and I'm not a stop loss underwriter. I am an underwriter, but not a stop loss underwriter. So I'm sure they're looking at a lot of actuarial tables that determine overall risk that are being applied. They're also hopeful that they have scenarios like Sun Life's experiencing right now, right, where we're paying 1.5 million and they're only paying out 817,000. Right, they're going to take some of that and they're going to cover some of their losers. At the same time, there's a reinsurance component to it as well, right? So they're out buying reinsurance within their book of business. So they've got some protection on large claimants. Very large claimants within their pool that they're sending that risk out elsewhere. And in some cases, there might be more than one reinsurer involved. So stop loss owners might be kind of layering risk within that exposure.
It's Bob Hamill. I just had a quick question. Do we pay the premium in one shot up front or is it paid over time?
Sorry, Bob, my headset just died. What was that question?
The question, just in terms of the timing of cash flows. I mean, a lot of insurance companies make money on sort of a bit of a float because they're going to pay the higher claimants later in the year as they hit their buckets. Do we pay the premium in one shot up front?
We're self-funded, so no for stop loss. You mean?
Yeah, stop loss.
It's a monthly payment.
Okay, so they don't
sort of pay a stop loss premium once a month.
There is about a little bit of float, but not, I'm just trying to figure out the economics for them.
Yeah.
Okay.
If I can add just a little color, my former employer, Swiss Re, writes both stop loss and reinsurance of stop loss. It's a very volatile business. Swiss Re continues to write primary stop loss like Voya or Sun Life, but it's just in the last month exited the reinsurance of stop loss, as did one of our peers, RGA, because it's so volatile. And that's going to put, all other things being equal, a little bit of upward pressure, I assume, on the primary market.
Yeah. Alan was kind enough to share that with me yesterday, and I had not heard that, but I agree, right? Having a player their size deciding to kind of pull out of that market, I think will be some concern, put some additional pressure on the stop loss market itself. The other issue we have, and we're jumping a little ahead to the projection, but the other issue we have is we can't lock stop loss in until 90 days prior to the effective date. So for the board, we're not going to lock our stop loss rates in until after your budget's already approved. And I'll talk a little bit about stop loss when I get to the projection and what I'm assuming. But that number is just kind of a placeholder. We get $1 million claimant tomorrow, and that changes things somewhat significantly.
One more left field question. Do we do any other business with this particular insurer or any affiliates of the insurer?
With Sun Life?
Yeah.
Not through the medical plan. I don't know, Sean, is there any other insurance lines where they're involved?
No, not with Sun Life.
All right.
Yep.
I thought they might be making it up somewhere else, but
Yeah.
gotcha. Thank you.
You're welcome.
Hey, Joe, one more,
yeah.
sorry.
Yeah, that's right.
We saw earlier that we were running pretty low so far this calendar year or fiscal year. So I'm
Yes.
surprised that Cigna is expecting an 18.2 million full year claim number. What's driving that?
Great question. Thanks for asking that because I wasn't clear with it. So this is the projection we came up with, 18.2 million last year at this time, right? So based on the running 12 months of claims, when we finalized the budget, I have it here, but I forget what month we used for our final projection. That's where we come up with the 18.2. And then as things have changed, right, we're just running better than that.
Okay.
That's not a reforecast of where we think we'll end.
Okay, thanks.
Yeah, good question. All right, let's talk about this current year real quick. We've got the $18.2 million is our expected pay claims. If you just do a straight deannualization of that, we get to $6 million. Our gross claims are in at $4.2 million. We have no excess claims so far within the plan year. So we are running about 1.9 million, or almost 31% better than expected. I will say that I don't think we'll end 31% better than expected, but given where we are this year, at the point this year, if claims continue, even with reasonable growth, we're likely going to end under expecteds this year. Typically I would say we're 4 months in. At 4 months in, if you're double digits below expected, 10 to 15, we're thinking, okay, you may be tracking towards expected claims. But be 31% under expected. That's a fairly good indicator that we'll end under expected for the year.
Joe, can I just jump in
Brian,
on the budget process here?
Yeah.
Right. So what we do is continue to monitor this, and Joe will keep an eye on it for us. And generally in the past, what's worked well is when we get into March and we're working and talking with the town council, really towards the latter half of March, we'll do a forecast, really look at a new projection based on updated claims when we get January and February in there. And it generally, if it continues to track to the positive, as it looks like it is, that's where we would do another projection and be able to take down the budget request. So it's a little early to do it now, and we figured just to wait till that last group with the town council makes sense, and then we'll have 2 more months of actuals under our belt, and we'll be able to make a more accurate projection for what we anticipate to be the claims.
So this calculation of the expected claims is based on the immediately prior year trend.
The most recent 12.
Yes.
To the point that I'm doing the projection. So it won't be the prior
previous,
year, right?
The previous trailing 12 months is what you're
Correct.
using. And so what happens with the prior 3 or 4 years of data? Don't you take that into consideration? What if you have an outlier?
Yeah, no, good question. So outliers we'll try to kind of manage, through the just kind of observation perspective. So like right now I have a client that has a really high outlier month. They're averaging like a little less than $1 million. They have $1.5 million month. And it's in our rolling 12. And, kind of Brian's point, they've decided, hey, we're going to kind of keep that outlier month in there. And then we're going to add a couple, as we see what the additional new months look like, we'll think about, hey, do we make some adjustment because we know that month was an outlier? It used to be, Chris, that, even before really I started doing underwriting. So I've been doing underwriting for 29 years. Just before I kind of got into it, underwriters would use 2 years of claims experience, not just the most recent 12 months. And that started to change for a couple of reasons. One, I think the main reason is claims just got larger, right? So the larger the claim pool gets, it tends to be a little bit more predictable over time. So you don't need 2 years. 1 year was sufficient. I think some of the nature of large claimants were more sporadic back then. So to look out over 2 years, maybe you were factoring in too few or too many of large claimants as repeating. And then it also has a pretty big impact on trend. I'll show you that if we can hold that piece of it. I'll show you that when we get into the projection. Because what it does is it extends our trend period, would almost double the trend period. And that is a pretty big factor on the trend factor that I use. And I'll show you that. I'll actually show you how that works when we get to the projection sheet.
Yeah, but okay, and I will have to look and see how those numbers run. But it would seem that the 24-25, if you look at the previous 3-4 years, was the outlier. And now you're saying, so from that you extrapolated 18 million. Now you're saying, gee, it's trending downward. So maybe a more conservative number last year would have been in order.
Yeah, and that, so if you look, right, so if I'm following you, right, we did actually we locked in with the October projection last year. So we updated it, but we never changed the budget position off of October. So last year we were locking in with claims through October, right, which didn't capture a lot of those high months in the projection period. But still what looks like to be a high projection, right? It looks like the projection is going to be higher than it needed to be, given kind of the improvement this year. And I think one of the things, Brian kind of hit on a little bit is, we might think, if you look, right, these months might be somewhat anomaly months, right? In the first 4 months of the year, maybe not the fourth month, but kind of seeing some additional claims months will help us. So one of the things that I would talk to Brian and Sean about, right, is if we had 1 month that was really high or 1 month that was really low, right, and it was the last month of my experience period, then I would say, hey, maybe we want to be a little conservative here because this could be either an anomaly low month or it could be an anomaly high month. And I think that's where Brian's kind of saying that's why we really like to look at claims through really February. I like to look at March, but I know for you guys, February, right? Because we can start to pick up on whether those months were anomaly or they were starting to kind of pan out.
And Joe, just if you wouldn't mind, I know you do the projections to all this, but you also have, does Signal also look at them, or who else takes a look at the projections as you're putting them together?
Yeah, so I do my projections, and actually I do my projections like a few different ways. I present it to you the same way every year, but I'm doing kind of 2 or 3 projections usually, and just making sure everything is kind of picking up, kind of going towards the mean here. But Signal will also do a claim projection using the same claim periods, and we're always very close.
And we also have an aggregate stop loss vendor, and they have a vested interest in that claim projection too, right?
Yeah, one of the fights I do have every year with stop loss is making sure that because your aggregate stop loss is set at 120% of expected claims, if I'm saying claims are going to be 18.1, but they're saying claims are going to be 18.5, well, that has an impact on your exposure. So we want to make sure that the stop loss vendor is using a claim projection that's similar to ours. It won't always be exact, but at least within a reasonable margin.
All right.
Does that help, Chris?
It does. I will let you go on with the presentation. Maybe more questions will come up.
Okay. All right. So in this next section, we talk about catastrophic claimants and non-catastrophic claimants. So what I'm doing is I'm pulling down the net claims from box from the first section, and you can see so in the 2020 through 2021 year, our net paid claims was 13,273. Of that, almost 5.1 million was for high dollar claimants, and again that's somewhere between 50 and 300,000. The remaining was for non-high dollar claimants. On average, in that year, we had 1,559 members on the plan. 46 of them were high dollar claimants. So a little less than 3% of your enrollment was driving about 38% of your cost. As you kind of work your way to the right, you can see we went from 46 to 48 to 55 to 54, and then last year to 63. And then what you can also see, right, is you can see that growing in your, because our enrollment stays somewhat consistent, right? So we jump from 2.95% to 3.15, driving almost 40% of our cost, then 3.7, driving 44% of our cost, 3.6, driving 43% of our cost, 4.2, driving 43% of our cost. What I'm seeing in the market now, and my clients now, is we're closer in this range from mid threes to mid to high fours percent of your enrollment is driving mid 40s to nearly 50% of your claim cost. That has two items that you need to consider, right? One, that puts pressure on your claim projection, right? More large claimants are going to add to our claims, but it also puts pressure on our stop loss, especially if they're exceeding stop loss. In some of my cases, actually just one so far, in one of my clients, 50% of their increase is related to stop loss increases. So stop loss premium is driving not 50% of their cost, right? But 50% of their increase is related to stop loss. So the two, I think, most important components of your overall cost is the large claimants themselves between 50 and 300,000 and what's happening with the stop loss premiums. Those are our biggest kind of moving pieces from year to year. I mean, obviously the claims is a bigger portion of it, overall claims, but those pieces tend to have more of an impact on how you're performing year to year. It's the large claimants and what's happening with stop loss premiums. At the bottom here, I need to go through line by line. This just takes those large claimants from above the over 50,000 and it buckets them by dollar range. And again, what you can see here is our highest claimants are listed. But I'm going to go to report 3 because I think this is a little bit more meaningful from a tracking perspective. So report 3 mirrors report 2. But what I'm doing is for each of the years, so for every year, right? If you go to report 2, I'm tracking the full plan year, each of these years, except for the last year, because I don't have a full plan year yet. On page 3, I'm tracking each of the plan years through December, right? So I'm tracking at the same point in the year at each of those plan years. So you kind of get a general idea, how are we performing compared to prior plan years? And what you can see if we just look at the large claimants, for instance, right, you can see in all of these years, right, we had more high dollar claimants than we do year to date this year so far. So we are seeing, right, I think a lot of the reason why we're running better than expected is because we are seeing some relief on those large claimants. And that's probably a unique situation. What I mean by that is I think most groups are still seeing increases in those large claimants. And if you want, I'll talk a little bit about this now. What's kind of driving that, right? So there's a couple different ways that we can see changes in large claimants. It's either that we have more people becoming sick enough to be a large claimant, or we have the same number of sick patients, sick members, but because of cost, right? They were 30,000 3 years ago, and now costs have increased, and now they're over 50,000. So there's a function of, is it unit cost, or is it that we have more sick people on the plan? I think it's a function of both, but I'm pretty convinced at this point it's more a function of cost per unit than it is having more sick people on the plan. We're just seeing that in particular hospital costs have really increased over the last few cycles. And when I say cycles, the carriers go out and negotiate contracts. Typically, they're 3-year deals. I think there's been a couple 1-year deals. There's been some 4-year deals out there. But hospitals were very open about the fact that they've lost money during COVID. And to some degree, I think they're looking to make some of that back up with their new contracts. That's a nationwide issue. It's not a Connecticut specific issue, although in Connecticut we're a little bit more susceptible to it because we really have 2 major health systems in the state. New Canaan's a little different because you guys utilize a little bit more New York than if you were Hartford, right? If you're in the center of the state, so you got some New York providers influencing your costs as well. But really in Connecticut, you've got Yale New Haven and you've got Hartford Healthcare, and they're really driving the negotiations on what their discounts are going to be, or what their discounts are willing to give up to the carriers. And we've seen that those increases have been higher over the last few years. There's some hope that that's going to moderate. Doesn't mean we expect costs will start to go down at hospitals, but at least not increase as drastically as they may have in the past.
Now, the numbers that we see here from the insurance companies about the claims, that's net of their discounts. Is it?
Correct. Yes. Yep.
Oh.
Yep.
Okay.
Yeah. In fact, it's funny. Gross. I mean, to be honest, right? I don't think hospital pricing, nobody pays the price, right? If a hospital stay costs, if the hospital bills a hospital stay at $300,000, well, if it's a Medicare patient, they're going to pay about 60 cents on the dollar, if not less. If they're a non-insured patient, they're going to pay nothing. And if we're an insurance carrier, you're going to pay, they'll claim they have a 40% discount, but really there's not a set price, right? So those prices are artificial, like the sticker price of a hospital stay, which is why carriers don't negotiate off of the total price, right? They negotiate by what they're called DRGs, diagnostic related groups. So they basically say, hey, we're going to pay X amount for a stroke that needs this level of care for this many days. And they're basing it based on that, not what the hospital charges would otherwise be.
And Joe, you shared earlier that, Cigna as our third-party administrator does not build any margin into the claims, right? When they pull
Correct.
the money out of the ISF to pay the claim, it's literally they're just moving the money from one to the other. They're not making any money on those transactions.
That's correct. So fee is paid is a per employee per month fee. There's no additional charges per claims charges at all. So I said to the earlier group, like when I first got into the industry, when I was at Anthem, we had a couple of groups that were they paid their admin as a percentage of claims. It was like 10% of claims was their admin fee. Everybody got away from that, especially as claims started to increase, right? You didn't want to give the carriers a raise just because claims were getting higher. But yeah, it's a fixed cost. There's no per claim fee. So this is what I had for running claims. Chris, unless there's questions, I can jump into the projection.
Go ahead with the projections.
All right. So hopefully this will look familiar to some of you. I know you only see it once a year. So I'll spend some time going through it. I'll make it a little bigger. So again, the way we do our projections is we're always going to look at the most recent 12 months of claims experience. And most of the projection is working between this first box and this third box. I'll talk about all the boxes, but most of the work's happening here, and then all the projections happen in the third box. The way the sheet is laid out is the first column is our current base year, right? So it's the current plan year, 25, 26. And then I've got a projection through November. And then we've done an updated projection through December. And then we'll do one with January claims shortly too, now that they'll be available. And so right now the board is still using the November projection. We can talk more about that as needed. But we'll kind of walk through kind of how we're doing the projection. So the first thing that I do is I bring in, I don't know how to get rid of this. There we go. I bring in my gross paid claims. And again, that won't tie back to any of the reports that I showed you earlier, because this is it's a 12-month period through October, right? I don't have a 12-month period through October on any of those reporting sheets. So I'm going to bring in my gross paid claims. They were 16.5 million. And through October 24, they're up to almost 18 million for October 25. I'm sorry, November 25, and it dropped down to 17.6 through December 25. So some improvement between November and December.
So, in 1 year you had 12 months, the next 13, the next 14?
No, they're all 12. So for every month, right? So October is going to be November through October. November is going to be December through November, and then this is January through December. So they're all a new 12-month period of time. Does that make sense? Okay. This next line is normalization adjustment. We added this during the COVID years. And so for that 2019 through 20 year, we saw that April through June, the healthcare system basically shut down. There were no elective procedures occurring. So we saw a significant reduction in claims. And so in that year, we added an adjustment. I forget what it varied by group. We used the actual kind of history of each group. I think we're probably around 5-ish%-ish, give or take a little bit there. And so we would take those claims and bump them up to say, hey, if this were a normal year, right, we call it normalization adjustment. If we normalize this number, we'd increase it by 5%. I'm not making any adjustments for COVID. I just kept the adjustment there. One, I still get people asking me about it. Should we be making any adjustments based on COVID? Not as much anymore, but last year I still got a lot of them. So I just kept it there. But it's a 1, right? So I'm multiplying the 16.4 by 1, so it's still 16.4. So I get my adjusted claims, which is again the same as the top line. Then what I'm going to do is here you see 2.349 million. What I'm going to do is I'm going to remove any claimant that is a large claimant. I'm going to remove all of their claims. So if Joe is a $380,000 claimant, I'm going to back out all $380,000 for Joe. So I'm going to take them out of the projection. I'm going to trend everything forward, and then I'm going to add Joe back in, but I'm going to add him back in at 300,000 instead of 380. And the reason why I do that is that way I'm not trending anything forward that's already an excess claimant, right? I'm just saying, hey, I know I'm going to pay 300,000 for Joe because I expect he's going to be on the plan next year at the same level. I'm not going to take 380 and trend that forward. It doesn't mean anything, right? So I'm going to add Joe back in only at the 300,000. And I'll show you where I do that. But that's why that number is so big, right? I'm removing 2.3 million. In this November projection, I was removing 2.9 million. And in December, about 2.8 million. If we had any benefit adjustments, we would adjust those here. For example, if the teachers were making a significant plan design change, they're a big portion of the group, we might make a benefit adjustment to reflect that. Or actually up here on the top, if they had half the year at one benefit level and the other half at a different benefit level, I might make a benefit adjustment here. It's a 1, so I'm not making any benefit adjustments. And usually we only make those adjustments when they're very significant, right? If there's a 0.5% adjustment to a plan design, we wouldn't make the adjustment here. If it's a 5% adjustment on the teachers, which are probably 50% roughly of the group, then we would think about making a benefit adjustment in the projections. So we get adjusted claims. Then I'm going to bring in my experience period contracts. That number looks pretty big. It's almost 7,500. If you divide that number by 12, that will give you your average enrollment, right? So if you take the 7,493, divide that by 12, you'll get like 630, right? That's kind of our average enrollment. And then I create a per capita. And so you can see my per capita for November was up about 6.38% over our base year. And then it came down a little bit in December, up 5.13%. In the second box, it's just more informational really than anything. Just kind of reporting out on large claimants. We had $7.2 million in large claimants over the running 12 through October 24 on 57 members. That went to 7.9 almost with our projection through November on 1 additional member. And then it dropped down 2 members, and it dropped down about $200,000, a little more, $270,000, $260,000 in our update through December. Of those that are over the 300,000, these are the numbers I backed out from above, right? So you see the 2.3 million from above, the 2.9 from above, 2.7 from above. That's how much I'm backing out and the number of members that I'm backing out. And then if the stop loss policy ran over that 12-month period of time, what would our excess have been? Would have been 592,000 on 4 members. Would have been 893,000 on 4 members, and a little bit more than $1 million on 4 members. Okay. Again, just illustrative. It doesn't really mean a whole lot. for the projection. And then here's the add back. So when I backed out this 2.35 million, I was backing that out on 6 members. So then I have to add them back in, right? I can't ignore them all together. So when I add back 6 people at 300,000, I've got to add back 1.8 million. Okay. I'll pause there for a second just in case I've gone too fast or if there's any questions. No? I can't see everybody, so I'll assume we're good. Okay, so we kind of get into the magic here is where we're doing the projection. And the very first line that you see is trend months. And you'll see this says 22, this says 21, and this says 20. So Chris, this kind of gets to your question about looking at multiple years to some degree. So what in the insurance industry, we always use an annual trend, right? So the carriers, the actuaries, the industry comes up with annual trends. And it's exactly what it sounds like, right? What do we think claims will be for a year from now, right? So a $100 claim today, if in a 10% trend, we think it's going to be 110 a year from now. The problem is I'm never projecting a year from now, right? I'm always projecting out way further than that. So, because I'm trying to make, in this first column, I'm trying to make October 24 claims look like August 2026, right? Because I got to cover that period all the way through the end of this plan year. So I have to take my annual trend and I have to convert that to what we call an applied trend, or sometimes it's called an effective trend. And what that does is it basically says, okay, that 12-month trend reflected for 22 months is going to be a higher number. So in this example, my annual trend's 8.28%. On a 22-month basis, it would be 15.7. Now, there's a formula behind that to create it, but the easy way to kind of think about that is if annual trend was 12%, that's 1% a month. In a 22-month trend environment, I'd be using 22% for trend. Okay? That same 12% trend, that if I added one more month, and now I was only predicting out 21 months, would go to 21. So I said earlier, when we look at claims, right, each month, we kind of have an idea if the month that I'm going to drop is higher than the month that I've added, my projection can improve. Well, I also get some improvement because I'm using one less month of trend. So Chris, what I was saying earlier about like using 24 months or even more, 36 months, what would happen is my trend would have to be much greater, right? Because I'm basically going to measure the midpoints of my experience period, right? So that 36-month period now to the midpoint of my projection period, which would just be a 12-month period. So, you could be doubling, tripling trend, the impact of trend. And there's some ways that you would factor that down. You'd wait 1 year more than the other. But what we've just found in the industry is that from a trend perspective and from a claim perspective, we really find the most recent 12 months is the best start point. So I'm going to take my per capita from above. I'm going to bring that down. I'm going to then increase that by our applied trend, right? So our 22-month trend in this year, in the base year. So I get my trended per capita claims. There's a margin line here. We don't use margin a lot. I don't have it there because I like to use margin. The only time that we've used margin explicitly, used it as part of the formula is when the ACA first, the Affordable Care Act first passed, and we had two pretty big components that we were worried about. We weren't sure how to price. One was children staying on the plan until age 26. And then also no cost preventive care. So we weren't sure what impact that might have. So we added some margin in those years. Another time you might add margin is if, Brian and Sean said, hey, we're going to hire 100 new employees. What do you think we should do? We might adjust, maybe add some margin in there. We can sometimes reverse margin, right? We can use a negative margin. We could use a 0.95, right? Because we know something's happening in the enrollment or with claims that aren't reflected in trend. So it's there that we can use it. We don't use it very often, if at all. So then I get my new per capita claims. I'm going to multiply that by our current enrollment. So I'm going to stick in the second column here just because that's where we are. So I take my per capita, I'm going to multiply it by my current enrollment, multiply that by 12, get a claim projection of 18,018. But then I have to add back those 7 members from above. So I'm going to add back 2.1 million, get projected claims of 20,118. I have 2 other adjustments here if we need them. We're not using them right now. Could be a second benefit adjustment. Sometimes maybe if Cigna's numbers looking different than mine and I'm comfortable with their adjustments, I might use their adjustment here. But basically, we're going to come up with a claim projection of 21.1 million. That did improve by about $600,000 using claims through December. And Brian, want me to defer to you on that for a second?
What's that, Joe? Just about continuing until February to
sorry. Yeah.
So again, that's why we'll have fewer months of trend and hopefully some more good news, and be able to bring that down even more when we look at it in mid-March, end of March, in order to, hopefully come in with a revised lower number for what we need to be.
Yeah. So the board currently still using the 20.1 million in the projection, even though there has been some improvement. I think what we'd like to see is what do the next 2 months look like before that kind of flows through.
Well, yeah, we also don't want the budget to be going up and down month to month, depending upon, the swing. So we'll you draw a line in the sand, and that's the first one. And then the second one will be in March. And that's where we'll do another projection, and hopefully it'll be improved. It looks like it will be. And that's what we'll lock in.
What's the logic again behind the applied trend? That's the monthly.
Yeah, it takes an annual trend number, right? It takes a 12-month trend and it converts it to the number of months that I'm projecting forward.
So how many months are you projecting? You're projecting 22 in this case?
So with claims through November in the second column, Chris, for the new budget year 26-27, I'm predicting 21 months forward, right? So I'm trying to make November 25 claims look like August 26 August 27 claims. So that's 21 months forward. When I update,
and you're assuming that the cost is going to go up 70 basis points per month for 20 months.
Yeah, that's basically what yes.
And why is that?
So trend is comprised of really 2 pieces. Price. So what do we think is going to happen with price and utilization? And then utilization kind of breaks down into a couple of things. So price is pretty simple. Like how much do we think costs are going to go up? Something was $100 today goes to $105 next year. And then with utilization, it's, do we expect more utilization? So are we going to have more doctor visits? Are we going to have more procedures? And then the second component of utilization is, and are those services going to be replaced by more expensive services? So a bad example, but an easy one to understand, right, is, hey, before I used to have an X-ray for XYZ condition. Now I need an MRI, right? So an X-ray is less expensive. It's replaced by a more expensive technology. So I didn't increase the number of services, but I have a more expensive service now taking its place. Think about with drugs. That's kind of big in drugs where maybe somebody's on a generic drug, a new brand name comes out, and it provides it's a more effective drug for one reason or another, and they move from a generic to a brand name drug. That's kind of what trend does: price and utilization.
What about the demographics of the underlying group?
Yeah.
Does that change? Maybe does it change that you have younger people coming in? So now you're going to have obstetricians and gynecologists, and the older ones are aging out, passing on. So you're replacing those oncologists and heart surgeons.
So yeah, those definitely impact utilization and cost, right? So our demographic factors. We don't typically represent that in trend though, because trend generally assumes a fairly stable demographic, right? So we're not going to go from an average age of 30 to an average age of 50 year over year, right? It might go 30, 30 and a half,
Right.
31, 32, right? Like it doesn't change that much. And so basically, Chris, what the formula is going to assume is that my column one, right, my base column has a very similar demographic as my columns two and three. So I don't need to adjust for trend because that's just showing up in the claims experience that I have, right? It's showing up in lines 1 through 4.
Now, I'm just trying to understand why that number of 70 basis points per month seems like a high number. How do you get
Trent,
there?
it's mostly a function of what I talked about earlier. It's mostly a function of hospital claim cost.
Of hospital claim costs.
It's mostly hospital claim costs. So drugs. So you can see it jumped up, right? So we're using 10.96 and 10.95, same number, but we're using almost 11% for the 26-27 year. We were using 8.3% last year.
Mhm.
And most of that change is related to cost increases, price increases.
Which you know and can quantify.
Yeah, we do rely. So we rely on the carriers for that, right? Because they have more insight, like they know what's happening with their pricing components. Now we will have conversations with with our clients sometimes. Hey, we think this number is there. We think Cigna's number is too aggressive or too conservative. We'll have those conversations, or hey, you've significantly outperformed a trend for several years in a row. Based on what we're seeing now, we think you still are. Can we use a more aggressive trend number? But we tend to, like here, we are using where I expect Cigna's trends to be, right around 11%.
Okay.
And so what we're really seeing is that historically drug trends have well outpaced medical trends, and we're seeing this year where they've kind of leveled off, where medical trends are almost as high as drug trends.
Now, if you were trying to analyze this data, and you were talking to an insurance company about a fully insured plan, would they be doing a similar analysis with the gross claims, and then they put a price on it?
Yep. So, I mean, if Cigna and I are off by 2% in our claim projection, I would say that's a lot, right? So usually Cigna and our claim projections are very, very close when we're doing them, because I do mine independently of theirs, and then you can usually point exactly where, hey, they're using like sometimes they'll make a credibility adjustment. Like there's a reason why their number is going to be different than mine. So what they're going to do, let's just say they come up with the exact same number I do, $20.1 million. Then they're going to add in their fully insured admin fees, which will be much higher, right? So our admin fees projected to be 543. They're going to add their fully insured admin fee in. They're going to add a reserve charge, and they're going to add some margin. So, and actually the earlier group, we kind of talked about, RFPs and other things and looking at alternate funding types. Those are all things that we can do. But I think when we did this exercise, and I wrote it down, Brian, I can't find out my messy desk. We did look at that 3 years ago, I think it was, and it was like 18 to 20% higher to be fully insured versus self-funded.
So you priced this out in the market?
We didn't do a formal RFP, but we had Cigna price out a fully insured model.
Okay. What did we discuss that at Board of Finance ever? I don't think so.
We had a meeting, that Board of Ed meeting over at South School, that had Board of Finance, Town Council, others were there, and we went through all of this together a couple of years ago with Joe and with members of Board of Finance, Town Council, and everybody else.
When that analysis was submitted.
Yep.
So that number sounds high, right? I forget the exact number. We can pull it out and resend it out. But the New Canaan will likely be higher from a fully insured to self-funded perspective because your stop loss premium, your stop loss level is higher. So what I mean by that, at 300,000, you probably have a little bit more liability than other groups your size, right? Other groups your size are probably $200,000 or less. And we've looked at that, by the way, historically, and 300,000 seems to be a pretty good number for you guys. And you're well reserved, right? So we're not worried about exposure there. Other groups are either not well reserved or they're not in a position where they can build up their reserves, so they have to have a lower stop loss level, right? They can't rely on their reserves as much. But the reason why that plays into the fully insured and self-funded conversation is when you're fully insured, the carrier will build in what they call a pooling charge. And what that basically does, or something they call an experience protection benefit, what that does is that basically acts like a stop loss in the projection. So it says, okay, New Canaan's gross claims were $18 million, but they had a good handful of large claimants. We're going to basically create kind of an internal pooling, an internal stop loss. We're going to charge you for it in the premium. We're going to build in a stop loss kind of within the model. And usually they would set that at much lower, right? They'd probably set it around 200,000, which means the premium, quote unquote, that they would build in is higher than the premium you're paying for 300,000, which I think is why that number was bigger when we looked at it a few years ago than what you might see with other groups. Last time, like generally what I would say is that it's about a 12 to 14% differential between fully insured and self-funded if you're using the same pooling level.
Wouldn't the stop loss go away and fully insured though? I mean, it seems like
you don't need it. Like it doesn't benefit.
You don't need it anymore, right?
It doesn't benefit the plan in the year. Like, so it doesn't impact your premiums at all. So let's use an example earlier. If our fully insured premium plan costs $12 million, you pay $1 million a month, right? I mean, if enrollment changes, it changes. But let's say enrollment stays the same. You pay $1 million a month, whether claims are 500,000 or they're 1.5 million. You're going to pay $1 million a month. And then next year, we're going to get an increase based on good or bad claims. What the carrier does to kind of protect the fully insured client is they build in this pooling piece where, like, for example, in 2019-20, you had a $3 million claimant. And if the fully insured carrier was projecting all those claims forward, right? So, I'm backing out all those large claimants, so I'm not going to add them in at greater than 300,000. They would be turning that $3 million claimant forward. So they're going to turn a lot of claims forward into the projection. So instead, they create this it's almost like a formula adjustment that you pay for that basically just serves to act like stop loss in the plan. So it's not true stop loss in that it's saving you any money, right? It's saving you liability. It's protecting the formula for the next year's rate increase. Does that make sense?
Yeah. One of the things that we hear a lot is suggestions that some of our neighbors that are fully insured are doing it better than we are in terms of overall cost. So I don't know that anybody around. They cover other towns near us that and can speak to it, but that comes up a lot, and it's in the water supply. It gets discussed a lot all over the place.
Yeah, and I've been involved in trying to help Brian explain some of those differences. It's hard for me to speak to other plans, but I share with our earlier group. The claim projection component is going to be the same whether you're fully insured or self-funded, right? So all the carriers are going to get to some number near $20.1 million, right? That number is going to be somewhat close to that. On the fee side, there should not ever be a scenario where our self-funded fees are greater than fully insured fees, because the fully insured, they've got to build in reserves, right? just like you need to reserve, they need to reserve, right? They're not going to have 100% confidence in their projection every year, so they have to build in reserves. They build in margin on top of those numbers. So if there's a difference between you and somebody with 630 people on the plan and they're fully insured and they're paying a lot less than you are, what that means is their claims are performing better.
Yeah, but there's, people talk about our neighbor Darien, and their demographics are the same as ours, and I can't imagine that Darien people are sicker than New Canaan ones. So it's just it's a hard one to address because it comes up over and over again with numbers taken from budget documents in Darien that appear to be less expensive than the ones that we're paying all in.
Yeah, I think we did some research on that last year. I know we did some research on that last year. Brian, I'm not sure where that we did a little bit more deep
We
down.
did.
Dive.
It's really very challenging to get an apples to apples comparison. I can tell you that I believe they're looking to go self-insured. They're looking to make a change and move away from fully insured into self. So, I think that we'll keep trying, but it's very hard to get to drill down to the level to make comparisons, because when you're fully insured, you're writing a check every month and it goes, versus being self-insured is why we know all the fine details about each of the costs, what it's from, each of the savings, the income and the expenditures. You don't get any of that when you're fully insured. So it's very hard to compare.
Yeah.
What are the barriers to exit or entry of going from self-insured to fully insured, or vice versa?
So let me talk to that. I answer that specifically, then I might follow up with a question. But so if you were to go from self-funded to fully insured, and let's just say for some reason it was the same exact price, right? So our I'm predicting 21.772, right? So Cigna says, hey, we'll do fully insured for 21,772,000 next year. And so you say, okay, well, we'll take that deal, because we think that we're to be that on a self-funded basis. So we'll take that deal. And what would happen is in that next year, you'd pay premiums monthly to Cigna worth 21,772,000. But since you're self-funded, you're going to have run-out claims from this current year. So if you think about how claims work, right, we have incurred claims and paid claims. And so every year, it's probably shown somewhere in your exhibit, right, we report the IBNR, the incurred but not reported claims.
Mm-hmm.
And on average, it's like, let's just call it 8%. It'll change month to month. Let's just say it, so call it 1 month of claims, right? 8%. So what would happen is in that year, so as of September 1, 2026, we'll start paying 21.772 million, plus I'm going to have to pay all those run out claims. So in that first year, I have additional claim liability. I have my remaining claim liability plus my full premium.
Mm-hmm.
So a barrier might be, it's not going to just be as simple as, paying the same amount of money I was paying before, because I have to pay my run out claims as well. So you got to deal with your run out.
You've got that $1.5 million or whatever it is, which is client.
Correct. You got to pay that. And we say it's 1 month, like it's 8% is about 1 month, right? But really it takes about a full year for run out. So what'll happen is, month 1's pretty high, month 2 trails down, but then you still have claims really for a whole year after. So you keep those open. Now on the flip side, if you were going from fully insured to self-funded, the opposite happens, right? So I'm fully insured, I'm paying Cigna my 21.772 million, and then I decide, hey, I'm going to go self-funded next year. Then I'm going to have a month, 2 months, 3 months of lower claims, because those claims there's a claim lag. And so a lot of groups, when they first convert from fully to self-funded, that's one way they start to build up their reserves, is by kind of utilizing that lag in the first few months.
So
there are some other issues, like it wouldn't be a huge impact here, but there's some Affordable Care Act taxes that come into play. There's we follow mandates anyway, but some self-funded groups don't follow mandates. If you're a fully insured group, you have to follow all mandates. Occasionally, we run into issues where, and I don't think this would be an issue for us, where Cigna hasn't filed the plan exactly like the plan that we have. That shouldn't ever be an issue for us because our plan is, I mean, our plan is unique to New Canaan, but we're not paying for things that don't normally get paid for. But there are some file differences in the plans that could make a difference, but I don't think those would be something to really be concerned about, and we could isolate all those.
Yeah. There isn't a chance in here that because we're self-funded, we tend to be overly conservative in our estimates, and so we are, in fact, costing ourselves more. I guess not, because the actual claims are whatever they are, right?
Yeah, I mean, and actually, if we look back on our second page of our claim reports, we've actually been a little bit over our expected, right? So my projections have been a little bit off.
Yeah.
The low.
Right, because at the end of the day, there are real people here getting medical care, and it is what it is. And those bills show up on our front door, and we have to pay them one way or the other.
Yes.
Yeah.
Yeah. And I think, Brian and Sean do a good job with this every year, looking at the projections and making sure that they understand all the different moving pieces, what the trend factors are. Like, this isn't such a great year to talk about it, but we had some years where trends were real low in the market. And, so we would talk about, like, do we think that's too aggressive? Do we think it's, do we want to use a more conservative? So we have those conversations every year. And the board's always been good. Like, we're not ever trying to, build in just to be conservative.
Well, I mean, eventually the claims are going to be there, and we're going to see them, and we're going to see the actual claims for X, Y, and Z. That's why the question way back at the beginning of this was, gee, on a 4 or 5 year trend basis, those numbers are different. So, but would have been lower if you had factored in those years. But what you're saying is that inflation and medical costs, due to technology improvements and broader diagnoses and other kinds of factors, have intruded in here to push those numbers up. I mean, essentially that's the thesis, right?
Yeah. So where I think where the variables are in the projection, right, is the prediction of what's going. Because again, I think a big component of the projection is based on the change in the number of those large claimants.
Mm-hmm.
If it was everybody under 50,000, generally over time, not necessarily in the last few years, but generally over time, I bet if we drew a straight line, we'd see that we were pretty close to projected for those claimants. And then the years that we spike above or below, it's because of a change in the large claimants or the dollar amounts in those large claimants. So that I think is the one variable, right? So we're having a good year this year. We seem to be having less claimants over 50,000. That seems to be trending forward in this current year. That could change next month, right? And that's really kind of the unknown, is what's going to happen with those large claimants. Now, Chris, there could be, like, part of me is saying, we're jumping from 8.3 to almost 11.
Mm-hmm.
I really kind of pushed back on the carriers and said, are we really that pessimistic? And, there's some thought that says that maybe the carriers have gotten a little bit. So over the last year and a half, 2 years, a lot of self-funded clients have been over their expected claim amount. And I don't know if the carriers are kind of hearing a little bit about that, like, hey, we were over our expected amount. And so maybe they're being a little bit more conservative with trend. But it's trending with the national data that we're seeing as well. So I'm pretty comfortable that the 11% is the right number. I'm hoping that drops off next year. I'm hoping we're kind of having 1 year bump and then we kind of get back into the high single digits.
All right, gang. Anybody else have some questions? I'm sure there are some out there.
And before those pop up, just last year we build in fees, right? Because we have to pay fees. So I did want to talk about stop loss a little bit. Right now, I'm assuming a 15% stop loss. I did talk to Larry, who's the town's consultant. He kind of handles the stop loss bidding. Like I said earlier, I think I said it with this group, maybe it was the other group. If we were just looking at just the board right now, I would expect that number to be much better than 15. I'm not sure how much pooling it needs to happen in the increase this year, but based on the way the board's performing, I think we hopefully will do better than 15%. The problem is I can't lock that number. We won't lock that number in until they see March claims. May claims. So we're not going to have that number until your budget's already solidified. But if the next 2 months look good, continue to look good, then maybe we can bring that down a little bit. But we won't have that number locked in.
Yeah, and who knows? So
and then for Cigna, I'm assuming a 5% increase. Hopefully it won't be that high. We've been managing increases much better than that with them, but that's just a placeholder.
That's their fees.
That's their fees, yeah.
Yeah. So at the end of the day, our cost comes down to what we actually have to pay for people's actual illnesses plus our stop loss insurance.
Yeah.
So going back, there's big calculation about what we think the future claims are going to be are only important because statistically the insurance company wants to use that in order to calculate what the stop loss needs to be.
Well, and in particular, what they really care about is just the large claimants. They really care about what's our stop loss, who's going to be over stop loss. That's what they're most worried about.
Okay, so then, but let them figure that one out. I mean, they have the history of that. They can kind of figure it out.
Yeah.
But why would we have to apply like an 11% escalator to the overall claims?
And well, because we
so that we have the proper reserves. I mean, is that what it comes down to?
No. So the trend factor is basically on all claims, and actually we kind of isolate the large claims from that a little bit, right? By adding them back at 300,000 instead of whatever the trend on that would be. But what trend is really saying is we expect that there will be price increases. So if no change in utilization, we expect some price increase. Probably about half of that, probably about 2/3 of the trend is probably cost. So we expect cost for all the same type of procedures to be more expensive by roughly 11% a year from now. And then the rest, well, it'll be a little less, right? 75% of that. And then the rest of that, we expect some more utilization or different types of utilization.
Right. So the reason, the lesson for us, or the takeaway for us, is that number with the 11% increase is what we as a town need to prepare for, as what we're going to have, since we're self-insured, what we're going to have to pay out the door.
Yeah, and maybe
the insurance company doesn't even come into it.
No. Only that they help us set. They have a better insight as to pricing impacts, and they can see trends in utilization data.
Yeah, so they're giving us input data to try to figure out what that future risk is.
So maybe one way to think about that, if you look on your screen, right? So if I was predicting out a year from last August, right? So if I knew, hey, we're a year from now, where are we going to be? If I had a 10% trend, right, I would take that 17,654 and increase it by 10%. And 2/3 of that number is going to be price related, and the rest of the third is going to be utilization related, or some combination close to that, maybe a little bit less on the price, right? So if Cigna said to us, hey, we know there's zero increase in cost, there won't be any increase in price next year, but we do expect some utilization increase, then we might see a trend of 4%, right? Because we think some utilization is going to increase. So then you could take this number and increase it by 4%.
Mm.
Right? That's the way to think about trend. It's what do we think this number is going to look like exactly a year from now?
Yeah, and from a financial point of view is what do we need to be prepared for?
Right. And then that's why you guys have reserves, because
so that big piece is based on estimates and analysis. And the other piece, which is stop loss, somebody says, well, I'll insure your stop loss for X dollars. And that's a known. And the other one is a known unknown.
So none of us, right? Stop loss vendors, the carriers probably have some insight, not a lot, but they probably have some insight where, they might see some $20,000 claimants starting to pick up that, oh, this person may become 150,000, right?
Mm-hmm.
We don't usually get to see that level of detail. We get some reporting from Cigna, and we have an annual utilization review meeting, and they're real helpful with that. But, problem is, with very rare exceptions, someone's not going to pop up on a tracking screen until they're a large claimant. So 50,000 or above, then they'll start looking at it. But we don't know who's not a claimant at all today, who might become one tomorrow. Nobody knows that, right? Cigna doesn't know that. I don't know that. The board doesn't know that. The stop loss vendors don't know that. So, that's the real risk, is somebody brand new who goes from 0 to 300,000.
Hey, Joe, doesn't it also show that we've been pretty aggressive? Just the fact that our actual net claims have been higher than what we've projected over the last couple of years?
Yeah, I think so, right? We haven't, some of it's related to increase in large claimants, right? That weren't in
right,
our
not that
base.
Just certain things that may have happened, but we're certainly trying to be as aggressive as we can within the range, because we've actually come in higher than we budgeted over the last couple of years.
Yeah.
We're hoping that this year is going to be a turnaround and we'll be able to, save a little bit. But
yeah.
Okay.
And what Brian's being nice about not saying is every year I give him a conservative trend as well. And I don't think I think if we used it one year, we would have told the Board of Finance in our presentation about it. But I'm trying to think if we ever used conservative trend.
I don't remember the Board of Finance doing a jig over these numbers.
Yeah.
No.
So, occasionally, for some groups, I might show just the opposite scenario, right? We're way outpacing projection for this current year, and we're using 11% trend. Do we want to maybe use a higher trend to hopefully not to prepare for maybe continued bad claims? But with New Canaan's always been very aggressive, using what we think is the most appropriate trend and not trying to kind of build in margin just to be safe.
Yeah, we try to be precise, right? As we do it all. Yep.
Can I ask a couple of questions?
Yeah.
One, just an observation. Sun Life is making a lot of money off of us. Last year to date, I guess there haven't been any claims over the 300,000, but we'll see what happens in the next few months. But it feels like 15% increase is high, but who knows? Anyway.
I think you're right. I think it is.
And then I know disability or work comp company, carriers tend to try to be proactive with claimants, finding out what's wrong, can we help you, so that it doesn't become a huge claim. Does Cigna do that? Because like 3 or 4% of our members produce 40% of the claims.
Yes. So Cigna has, we have, in our Cigna plan, we have their full utilization management, care management protocols. For the most part, those are all voluntary. So, a member doesn't, if a member has cancer, they'll have outreach from their oncology team. the member doesn't have to engage with them. It won't change their benefits, right? They're not going to say, "Oh, if you don't talk to us, we're not going to cover certain things." So to some degree, Alan, it's dependent on whether the participant wants to participate in those programs or not.
Yeah.
But they are available. And then we do have a wellness program at New Canaan. It's very well run. It's Darlene on the call. She manages that team. It is by far the most interactive group that I work with as far as wellness. 18 to 20 people, I think, are on the committee, represent each school, represent the different unions. Each school kind of has their own direction that they can take. It all kind of runs through the committee. But so doing lots of things. Now, those aren't, we're not paying incentives for people to do things like that, but it's, are there wellness programs that they can run in the place, run at each school to try to help encourage wellness. And so that actually, our wellness fund from Cigna went up. It was 15,000. It went up from 15 to 30,000 for this current year. So Cigna is kind of investing a little bit more for us in that. So that's one way, Alan, we kind of get at it. But from a Cigna perspective, so there's lots of different services that employees can access on their own. But if there's certain diagnoses that they're going to get outreach to directly from Cigna.
Okay, thanks.
Yep.
I have a financial question, and this may be more towards Sean. But, you said the school district is well reserved, and that's an important consideration when you think about the excess point of 300,000. Are we overly reserved?
The town is well reserved.
Yes. So
the town stands behind the school's obligations.
Well, okay. Well, at the town level or the school district level, are we over reserved relative to a 300,000 attachment point? Or are we just adequately reserved?
I believe we're adequately reserved.
You're saying on behalf of the board or the town?
For the board.
Okay.
Yeah, so our target and our reserves, so we have the two different stop losses, the 300,000, but then we mentioned that's the individual. Then we have the aggregate, right, which is 120%. So that we call that 20% between 100% of claims and 120%. We've always called the corridor, right?
Yeah.
And we hold 8% of that, and the town holds 12% of that. And that's worked very well. It used to be we held 100%, and then it shifted to us holding 12%, and then it shifted to us holding 8%. And so in that ISF is 8%, we target 8%, and then the town holds the additional 12%, so that 20% is always accounted for if need be to get to that aggregate stop loss.
Right, but that's a gross number, and that number could sit almost anywhere on the town's balance sheet.
Well, we've agreed
like convention, we kind of split it with you, but you wouldn't have to have it that way. It could be.
Well, yeah, we agreed to this through the years through policy with the Board of Selectmen and others, right? We have a policy around this that does the 8% with the Board of Ed and the 12% with the Board of Finance. And you're right. I mean, it's all, it's as we say,
it's the
same
town,
pants, different pockets, but
yeah,
the key is to be able to access it quickly if need be, which is why we felt the 8% was enough in case there was something catastrophic that had to happen. Because we're not our individual stop loss vendors, not our third party administrator, there can be a lag between the payment and the reimbursement of the excess costs above the 300,000. So we've always felt like we should have something in the ISF to cover just in case, and so that's how we landed on the 8%.
Yeah, because at the end of the day, there's one pool of money, and it comes from the taxpayers of Buchanan. The town is the only taxing authority. The school district does not have taxing authority, and so all the money flows in from the citizens of the town into the town coffers, and they constitute the we pay for the ongoing services of the town, the school department, and everything else, and then we build a reserve against a whole bunch of things, one of which is these medical costs.
But I guess my point in the budget is we allocate a contribution to the ISF every year. That's an important part of the Board of Ed budget. And intrinsic in that is an amount of reserves. So if it's, just to be provocative, if it's too much, then the taxpayers are overfunding. If it's too little, the taxpayers are at risk.
Yep, which is why that 8% and 12% and how that was all landed on exactly. That's always the target, is to be precise on those numbers.
Okay.
Yep.
And in full year 24, we were under reserved. That improved in full year 25 actuals, and we're projecting to have an adequate reserve for full year 26, which is the reason why, as you'll see when we show the ISF chart, which is why that the year-to-year increase in the Board of Ed operating contribution is only up $139,000 year to year, or less than 1% increase.
If it's all right with you, Chris, how about we flip over to that now?
Yeah, absolutely.
Great.
Hey, I just have one follow-up question. I wanted to piggyback on what Alan said before. So if Suncor is raising their premium 15% for the stop loss, what has to happen in order to initiate a competitive analysis? Who makes a decision to say, hey, let's go out into the market and see if there's a better deal out there for stop loss?
Great question. It's automatic. So again, the town's broker, Epic Brokers, Larry Kirshner, he does. I think he kind of has two different ways he'll do it. He does a market check every year, which might not be a formal RFP, just kind of checking the market to say, hey, where are people kind of coming in at? What, is there interest in looking at us? And then there's formal RFPs. But there is some look at the market every single year.
So they reviewed the market and they feel that the 15% increase is our best deal?
Yeah. And again, I want to be careful that 15%, that really is a placeholder. And I would, again, if this were just the Board of Ed and we had more insight as to how the town performance is, and again, you guys might have some of that insight, but I would expect less than 15% based on our last 2 years of performance. But 15% is kind of like the average increase for groups that are running well. But I think we're running better than well.
Right. So that number can come down as we'll look and see where we are after we see January, February numbers. And as long if we are trending the same way, that's our budgeted number, estimating where we're going to land.
Yep. Okay.
But what I'll say, Victor, to that is, I think you have the commitment from Larry and I that we're not just going to accept 15 to accept 15. One of the things as underwriters that we'll do is we do our own projections, right? And figure out what do we think should be going on, and what do we think the number is, and kind of the carriers come to us with a number, and then we push back on that number and say, well, hey, I can't tell you how many times I've sent exhibits to stop loss vendors saying, well, hey, you've factored in this, and this, if you figure this. So all that is very helpful when you can talk underwriter to underwriter about assumptions. And sometimes they convince us, right? Hey, we think it should be 8. They're saying 12. And they're like, well, did you factor this in? You're like, oh, maybe they're right. Maybe 12 is the right number. So that number is not just going to be accepted. It'll be shown, it'll be calculated, and then we'll decide whether or not we think it's reasonable. Now, I will say, if I think it's 12 and the market's coming in at 18 and we get 15, right, we probably would take a lower number because that's what the market's bearing. But typically, we can generally get an idea of where we're going to be.
Okay.
Any other questions at this point? All right, Sean.
Okay.
Sean, I'll pull up the page in the budget book.
Yeah, that'd be great, Brian. Thank you. So this is the ISF chart, page 98 in the budget book. The top portion of the chart are the revenue inflows. The middle section are the expenditures, projected expenditures for full year 27, and then it results in a change in the fund. for the year, which would then get added or subtracted to the opening balance. So if we start with revenue, first of all, the biggest piece of the revenue is the Board of Ed town contribution to the fund. And as I mentioned earlier, the requested for 27 is 18,551,000, which is an increase of $139,000 or less than 1%. And the reason why it is so low relative to other years is that over the last 2 years, as I mentioned earlier, that we've increased our fund balance with a reserve that was more than adequate. And this will enable us to absorb a negative change in the fund balance for the full year 27. So if you look at the chart, when you see net change current year for full year 27, with the revenue inflows and the expenditures, we're projecting it would be a net decrease to the fund of 803,000, which would be fully absorbed by the fact that we've got a reserve, a closing opening balance for 7/1 of $3.2 million. So we'd be able to absorb the $800,000 net change in the fund, plus still maintain a reasonable reserve balance for any exposures in full year 27 and onward.
Sean, if you're projecting the 800 underrun, if you will, that can be fully absorbed, why are we asking the town for more?
The 139 is what we could is what we're asking, based on the numbers that the revenue and the expenses. I mean, we probably could, if we were able to reduce the stop loss premium, we probably would be able to eliminate that 139 increase.
Well, and just to share too, Nick, that when we do another projection after we see January, February, if we see the same trends that we've seen, then that could also bring down what those contributions need to be, because that really is that's based on those anticipated claims, right? So that if the projection improves, then that number will decrease.
But it seems like you're solving for a projected end fund balance. I mean, that's how you determine.
We do.
Right. So how do you think about that? How do you come up with a projected target fund balance?
We look at the revenues and expenses and we cover what we can with the reserve, and that results in a closing balance for the year. And in this particular case, it's 780,000.
Could you scroll it up a little bit?
Sure.
The other way, sorry.
Oh, sure. Down. So that's where the the 8% or the 40% of the 20% comes in for the target reserve that we look to have in the ISF, right? So we have our IBNR and we have that 8% corridor. Excuse me. And that's using those two targets. That's where we build our budget around. So if there's more than that in, then we're able to use that to offset the new cost. If there's less, then we have to build in additional cost in order to get back to that number. So that's some of the planning that we do as we look at where the fund balance begins and ends at each year in 7/1 and 6/30.
When I just have a question, when was the last time we got to 40% of the stop loss corridor, or have we?
We have not. We haven't.
So we're being pretty conservative there to assume that we're going to hit $1.6 million in the. What is in the last 5 years? What's the worst we've done in terms of eat into the corridor?
We can go back to Joe's exhibit before if we want to, where he talked about sort of projections versus actuals. The Board of Ed, though, has always felt very strongly that we should be fully reserved for that 20%. Because then, you know, we have the aggregate stop loss at 120. So to feel that confident in the plan and know that if things were to go in a bad way, that we'd be covered up to that amount. There is legislation that says that a Board of Ed that overspends its budget can be held personally liable financially. Hasn't happened in Connecticut, but it is on the books still that's a possibility. So that's part of the reason the Board of Ed has always felt strongly that
I
way.
mean, obviously, we've got a AAA town that stands behind this
Of
in
course,
its entirety. So that,
which is how we got
but I could see how towns that are in poor financial shape, if you're not adequately reserved, then bills don't get paid.
right. And that's how we got to the split. You know, it used to be that Board of Ed held all the 20%. And that's how we got to where we are now with the 8%, 12%. Confidence and trust in each other, which has worked very well.
Right. Okay. Thank you.
Sean, the IBNR hasn't changed for the last 4 years?
We
That
just
we got from the actuary?
we just reflect the IBNR in the actuals. We don't
Right, but the actuary providing the IBNR forecast, if you will, hasn't changed. They have just everything stayed stable since whenever that was, 1161.
We've brought it down a little bit. It was about 10, 11%. We've got it down to about 8%, wherever it is. So we've used that as a way to reduce the cost a little bit.
Right, but the IBNR usually gets provided by an actuary. That's not something we come up with.
That's true. Joe gives us a couple of scenarios and we usually pick the middle ground.
Okay, and that number came from Joe's calculation.
Correct.
Yeah, I use a couple of different formulas, models to generate a range of IBNR, looking at historic results, and then most recent lag reports is kind of how I come up with it.
Mm-hmm. And the 1161 is the median then? 50th percentile?
I'm sorry, what was that question?
Is the 1161 then the 50th percentile?
1161.
I think it's a little bit more aggressive than that. Again, trying to bring the total cost down a little bit.
Okay. As long as this came from Sean and it's reasonable, because usually IBNR always changes every year, so I was surprised to see it flat 4 years straight.
Sure. These are, I know it's 4 different columns, but it's the 25 and 26 budget projected and proposed for 27. So,
okay.
Of course, this all assumes that there's expenditure of $20 million is the actual number. If it's more like 19 something or other, you guys are off by $1 million.
That's correct.
Could I just ask one other question around the corridor? In the catastrophic situation where we fully max the corridor, would it be right for me to think about that as this 1,609,000 and divide that by 0.4? Would that get me to because we're sort of assuming a 40% hit, and to get the 100% hit, am I thinking about that right? I'm just thinking in terms of, okay, you max the corridor, that, what does it look like?
So the max corridor is 20% of anticipated claims.
Right. Okay.
So
is that around maybe $4 million? I'm just curious.
Yeah.
Okay. So then my math.
It would be,
okay.
If it's $20 million, it would be exactly, it'd be $4
Yeah,
million.
it's 4. So it's a tad over 4 million.
Yeah.
So, and we're reserving 3.2. So, okay. It basically through this.
Mm-hmm.
But we'd end the year with nothing. So I got it. Okay.
Right. And again, that's the aggregate stop loss is significantly less expensive than the individual and everything else, because it is.
Yeah. Oh, no. And we have to have stop loss, and we have to have the individual. I'm just trying to figure out what the disaster scenario for the town is. And it's not that, I mean, it's horrible, but it's not, you're conservatively positioned
Right. And of course, we'd use this before going to the town reserves.
Right, right. So we'd be in for another 500,000. Okay.
Yep.
Thank you.
And furthermore, you wouldn't even see it until 6 months after the end of the fiscal year, the final number. If we're all this roll through, right?
It does take time, yes.
Yes. So in any given year, it's very unlikely that you would get to that 4 million. Without knowing that it's coming down the pike.
Oh, sure. Well, yeah, that's how our individual stop loss helps protect us from that too. Yep. Okay.
So the employee contributions basically get allocated across most of these costs that are, and it looks like they get eaten up by all these various costs that you have in addition to the claims paid, basically, right? I mean, your total expenditure is 23.2. The claims are about 20 million. Employees are putting in 3.4, which is just about the other costs other than the claims.
Yeah.
That's right.
Yep. I mean, of course, it's not broken out that way, but yeah, that makes sense, Chris. That's one way to look at it.
All right. Any other questions?
Yeah, is the increase of employee contribution from 3 million this year to 3.4 next year, is that because you have are there each employee is paying more, or you're adding headcount, or a combination of the, it's probably a combination, but which
It's
is
a
the
combination.
factor?
Each bargaining unit, for the most part, has a increase of a half a point to 3/4 of a point each year, an increase in premium share.
So which factor was more caused this result, was heavier to a heavier factor for this? Was it the increase to the individual, or was it because you had more employees in the
Increase to the
plan?
individual.
Okay.
Do you shop for the prescription provider as well? Like you shop for the stop loss and the carrier?
We have not. Cigna is Express Scripts, right? Cigna owns Express Scripts. So Cigna is our PBM as well. But that can be looked at, through the RFP process if that is decided to do that.
Yeah, I mean, we do it at our company, and so we do that, and sometimes we get even better deals, more discounts, refunds, rebates.
Yeah, usually it's on the rebate side, right? You can see somebody carving out can change the rebate position. There's some complications with that, but I mean, not insurmountable, but there are some complications if you have two different vendors handling it, but it's, again, not insurmountable.
So Brian, the employee contributions, that is part of the collective bargaining agreement, right?
Correct.
Yeah, so it's by contract.
Yep.
So that's all been agreed to. Everybody's on board. It's not a big surprise.
Exactly. Yep. That's all contractual across all 6 of the groups that we have. Yep.
All right, good.
I kind of had that question on the earlier call when we were talking about it. Is that also possibly a difference between New Canaan versus Darien in terms of how contracts and how beneficial they are to our employees versus what their agreements are? I don't know if you have any feedback on that.
We tend to be a little more aggressive than most. Every one of our groups is at or above the 20% of the premium share. And the HSA, employer HSA deposit is a 50-50 split. Sometimes they'll go 60-40 with the employer doing 60% things. So we tend to be being above 20% with each of the groups, puts us in a pretty strong position on that.
Anybody else?
I would say if you haven't had a chance to yet, take the time, if you will, to read the narrative that leads into this section around the ISF and sort of all of the information about premium sharing and sort of how it all works. There are lots of fine details that go into it, but our sort of guiding philosophy and other information is all included in there. So it's all in the budget book. And for anyone on the call, that's all online at the Board of Ed website. Just go to the Board of Ed tab for the budget and you'll see the entire budget out there in a PDF.
Okay.
Thank you.
Yeah, thank you. It's a great presentation.
Let me do that. Well, we're glad to be able to be here with you tonight. Thank you.
All right, Brian, thank you. Thank you for making Joe available to us. Sean, thanks for showing up. We appreciate it. And we get to have another game with you on Thursday.
Yeah, looking forward to it.
Okay, so we'll see you soon.
All right.
Good night, everybody.
Good night.
All right, good night, folks. Thank you.
Good night.
Chris, yeah, go ahead.
So, guys, I skipped over a part of the agenda here earlier. We do have to vote on the minutes to the last three meetings, the February 5th, 12th, and 14th, right?
Yes. Yep.
So we can do them all together unless there are any comments. So are there any comments on February 5th? No. February 12th? February 14th? Okay. Can I have a motion to accept the minutes as submitted?
Motion to approve, accept the minutes.
Thank you. May I have a second?
James. Yep, I saw James there. Yep.
Okay, good. All in favor?
Aye.
Aye.
Aye. Okay. Any opposed?
No.
Okay. And then we have one more item here on so I've lost my page here. What's the last thing here?
The tax supported capital project reclassification. And there she is. Ann Kelly Lynch can walk you through it.
Okay, Ann.
Good evening. I'll make this one quick. So in 2025, tax supported capital, the fire department asked for a search maze funding for $20,000. The chief says he no longer needs that maze, but he put in fiscal year 27, he put in a forcible entry door and I think it was a fuel flow, I forget what it's called, flow meter for $20,000. So we're looking to approve to take the 2025 approval for the maze and move that to be the forcible door entry. And then we can eliminate his request out of the fiscal year 27 budget.
So we get to take $20,000 out of this current fiscal and reapply it to what has been previously approved.
Right. We're just changing the nature of what he's using that 20,000, the original approval.
Okay. All right. Any discussions? No. All right. Can I have a motion to approve this transfer?
A motion to approve.
Thank you, Steve. Second?
Second.
Who was that?
Bob.
Bob. Okay, thank you. All right, all in favor?
Aye.
Aye.
Great, thank you.
Anybody opposed? Okay. All right, that's our agenda for tonight. Anything, Tucker, we need to...
Nope, just a motion to adjourn.
All right, who wants to make the motion to adjourn?
Motion to adjourn.
Nick.
All right, Nick, thank you.
Second.
Doka, Steve.
All right, all in favor?
Aye.
All right, folks.
All right, we'll be back in person on Thursday night for anybody. If you're not able to join us and you're going to be remote, just let me know so I don't set up a seat for you.
Great.
All right, everyone. See you Thursday.
Thank you. See you, everyone.
Bye.
Thank
Take
you.
care.
Bye-bye.